This is our Forex blog for March 14th, 2014. And one of the easiest ways of trading is just using our currency indexes. This lets you see visually what each currency is doing. And you can see that the dollar is trending up, and it has a little pullback, comes back up, doesn't quite come back to the high. It's kind of a 1, 2, 3 reversal pattern, almost a double top. Pretty high probability reversal. And if that's not enough, when it breaks the trend line here, it's pretty much confirmed to be in a downtrend until it breaks back above that trend, so trend line from above. So this is a great place to be looking for a sell, especially since the weekly and monthly trends are down here. So that being said, you want to sell the dollar. You want to sell it against a currency that's stronger. So one such currency is the euro. You can see it went from underneath its hourly to above it. It was above its VWAP, volume weighted average price, at 3. This is a pretty decent one to be looking to buy it against. The yen is also in an uptrend, but it's just kind of going sideways. It's also near the upper band, and so it could very likely pull back. This one's also near the upper band. However, it just broke the hourly moving average, and so everyone who was short for the last half day or day is likely to be having some stops hit, and that can cause some upward pressure. This one also is likely to make its way up to the point of control, the most actively traded price the previous day, which is way up here. And the dollar, if it does fall, it could work its way all the way down to 103. It's a good amount of distance there. So we bring up the euro dollar and look for buys after 3 o'clock in the morning, and you can see, here is a trend line. It broke it right around that time. So if you want to get into that trade, put your stop, a little bit underneath the low here, underneath here. You can see it had a very nice win here. You buy the pullback. Again, put your stop underneath there. Very nice win. There's really only 2 methods that we use when we manually trade. Find a strong currency and look for a pullback or a sideways rectangle breakout. Now, in this case, it went sideways. It didn't break out over the high. A little bit later, it pulls back, so you have a pullback trade instead. And really, the only key to trading is having small losses and bigger wins. And you can see the wins are considerably bigger than the risk in every instance. You buy this little pullback here. Let's say you lost. All right, you get back in again here. The wins are bigger than the losses. And that's why the currency indexes are so powerful and such an easy way to trade. Let's scroll forward a little bit more. You can see the pound. It's in a downtrend, comes up to the hourly, can't get above it. You can use rectangle patterns on the actual individual currencies. Right? So this is in a downtrend. It has a nice pullback. This is actually a combination of a pullback and a rectangle pattern breakout. At 330 right here, this one, breaks out to the downside. And so the euro is strong, the pound's weak. You can look for euro pound buys at around 3 o'clock. And you can see, again, off to the races, big move up. Let's look for some other currencies. Sometimes currencies are down, the trend's down. You wait for a pullback, you sell, wait for a pullback, you sell, wait for a pullback, you sell. If it can't break an area for an hour and a half, 2 hours, it's pretty much likely to get a bounce back up to the hourly moving average, and if it gets above there, the upper bands or the point of control areas. This one has a daily trend that's down, a weekly trend that's down. Let's take a look at this pullback to the hourly. Great place to sell it. It's extended. The monthly trend is up a little bit, but the daily and weekly trend is down. So you're looking to sell this one here at 4. We want to find a strong currency to buy it against. Well, the Swiss is kind of going sideways, but it's right at the hourly moving average. The weekly monthly trend is up. If this breaks out, it has a lot of room to run. Even if this one kind of goes sideways or even down, this one's likely to go down farther and faster than this. So you can still make money if you get into a trade and they're both going together in the same direction. Whatever one's going more intensely, you're going to make money on. So The Australian is likely to go down. The Swiss is likely to go sideways or up, or if it does go down less violently because the weekly monthly trend is up. So if you look at this at that 4 o'clock time, you can see, you got a nice, well, it wasn't that big of a move actually, probably 15 to 20 pips, but it did go down. So let's take a look at once you're into those trades, you can kind of watch the charts. All right, this one's going up, the Australian's going down. All right, now the Swiss is starting to come back down and go sideways. The Australian, pulled back a little bit. The last move was up, even though the longer term trend is down. You're out of your trade. You take a small 15, 20 pips profit. Let's look for some patterns real quickly. Daily, weekly, monthly trends down, and so if you see, a counter trend move up and it breaks the trend line off the lows for many hours, pretty high probability place to get short, especially with resistance, hourly moving average right above it. So at 8 o'clock, which one's likely to go up? Well, like I said before, the Swiss, it really didn't pull back, broke above the hourly moving average. This is the daily, weekly, monthly trend are all up. This is a good one to be trading against the CAD. Weak CAD, strong Swiss. You want to sell the CAD Swiss, around that 8 o'clock time frame. So here's 8 o'clock. You also happen to have, just pure sideways consolidation, very tight range. When it breaks out of that area right here, you go short. If you really want to be safe, you put your stop above the high, and it kind of goes your way, comes back up. At that point, when it starts going down again, you want to move your stop here, because if it kind of stalls here and shoots back up, you don't need at that point to know the trade's not going to work. If it comes back into this range and above this high here, it's not going to work probably 80-90% of the time. So move your stop down, and now your risk is cut in half, and you can see it just finally takes off to the downside. If you get out of your trade somewhere in this area right here, this is your win. This was your original risk, which quickly got cut in half, and you can see your win is considerably bigger than what the risk is. And again, that's the key to trading. It doesn't matter what your win percentage is. I've had days where I'm 35-40% winning, took a lot of trades, maybe had 1 or 2 big wins. A lot of your trades, you're going to lose less than what you initially anticipated. And what's nice about this is you can not only watch the CAD Swiss go your way at 8:30 or 9, but you can also watch the currency indexes. So let's scroll these things back at that 8:30, or actually a little bit before 8. All right, so if you're in that trade, you can see this one's falling, the CAD. The Swiss is up near the highs of the day. It's pulling back. All right, now it just made a new high right here. And the CAD is right near the lows. It could stall right here at the low. Whoever was buying, all the people in the market buying here before can buy again at the double bottom. That happens all the time. But if it shoots through that area, you have a very good chance of having a much bigger win. And you can see it did find support there. It's also at the point of control. This is the price most actively traded during the previous day. If you look at the CAD chart, it spent a lot of time right here. Went up, came back down, spent a little bit of time here. Went up, down, spent a little time here. For the whole day, it spent the most time at that price. And so it's, it's a natural support area. It's either going to bounce off of that or it's going to go sideways. And if it only goes sideways for half an hour, it's likely to go lower. And you also have your fib targets on these. You draw your fibs, and you have a good place to shoot for. If it gets down to the fib target, more than likely that move is going to be over. So we'll draw the fib targets on the Swiss as well. And you can see the CAD's reversing, coming up to, 9 o'clock a little bit. All right, now the Swiss just took off. It's at the first fib target. You actually got a pullback on this trade too. And having these charts so small that I can actually put them up on the screen so everyone can see, it doesn't really let you see inside these fib areas very well. But that previous trade that you sold, you know, when the CAD was going back up, you could have just scalped this trade and gotten short again. You know, there's nothing wrong with taking multiple different trades. I mean, you can get in and hold for a couple hours, or you can take trade after trade after trade. And when you do that, it's much easier to use, you know, range charts or tick charts. Here's a 5 pips per bar range chart. And this makes it really easy to get rid of the noise in the market. Each bar is 5 pips, unless, you know, during that bar there's a gap. So you can very easily see when the market's dead, there's very few bars. You get short, stops right here, it's going down, you get out of your trade, comes back up, you go short again, you put your stop, you know, a few pips above the high here, and it's got to close above there if you use range bars. And then you can just walk this thing down. Same thing for tick charts. You know, you can try 35, 50 ticks. Each currency is a little different with how many price changes per bar. But this also lets you, you know, with very low risk, take trades, you know, with a very tight and tighter stop, and you can do the same exact thing. You know, comes down, makes a little pullback, you move your stop back up, comes down, you have a very small profit here, comes back up, you go short again. You know, it's not really falling away that time, you move your stop down real fast, you get stopped out pretty much at break even, go short again, very, very low risk, comes down, goes back up, you move your stop down, and you know, you can just do that. And by doing that, you have, you know, very small risk, your profit's a little bit bigger, very small risk. You know, you can see you pretty much broke even on that trade, very small risk, much 4 or 5 times bigger profit. And that's what's, you know, makes scalping such a preferred way of trading amongst people that trade for a living, because you can take a lot of trades, the odds, you know, improve the more trades you have. If you only take two trades a day, you can have many days where you have, you know, losing days. You might lose both of those times, or win one, lose one. You lose 8 pips, make 8 pips, you broke even. Or if you lose 8 pips and make 4 pips, you've lost money for the day. So the more trades you take, you know, the odds go back up in your favor. That's it for today's class. I'm in the process of converting our trading system over from Visual Basic to C++, which, you know, will give me a lot more room to add more abilities to it. I do plan to release a new one this weekend with this week's updates, but you know, I think I've hit the limit with what I can do with the trading system using Visual Basic. It's about 15,000 lines of code, and it's just not the most efficient programming language. So not only am I converting it, but I'm also learning C++ in the process. Our whole program is written in C++. Very powerful, very efficient programming language. So my partner is going to help me convert the 15,000 lines over to it. We think it's going to take about a week or two, and then we're going to be adding a lot more powerful functionality to the trading system.